Changes to the capital gains tax discount, negative gearing and the taxation of trust funds have all been flagged. To take a look at what these changes could mean for the individual, I'm joined by KPMG Australia partner and Victorian tax lead, Ursula Lepporoli. Good afternoon to you, Ursula. Thank you for your time.
Hi, Kath. Thanks for having me.
Now, we are being primed to expect these changes to the CGT discount and negative gearing. Firstly, when it comes to the proposed changes to the CGT discount, what impact do you think this could have on shares and then indeed on property?
Oh, look, yeah, the changes to the 50% discount, there's a lot of conjecture out there and people guessing what might be happening, but the government is giving us some clues. It's really just reducing the tax or potentially the discount on long-term held assets. What we're seeing is a proposal that might move it towards what we had before 1999 when the 50% discount was introduced. And it's going back to kind of like an inflation-adjusted approach. And where we see that happening, it might not actually be so bad for long-term held assets. But we might also see people then favoring shares where they might have assets held for a shorter period of time, and there's less question about what the cost base will be, because what one of the proposals out there that they might actually increase the cost base to reflect inflation over the period of time. So it might cause taxpayers out there to decide that shares are a more known quantity. We'll see.
Yeah, and it could potentially, does that make income producing shares then more attractive than growth shares?
Good question. I'm a tax professional, not a financial advisor, so I can't give you tips on that.
Sure.
It's about looking at the whole asset class, looking at the dividends from the shares, looking at everything all together and your investment horizon.
Yeah. With respect to trusts, we know that they are in the ATO's sights as well. What are the anticipated changes coming, and how would you be advising clients around that might hold some of these discretionary or family trusts?
Yeah, well, I think with the CGT, it's easy. If you want certainty, take action now. You got until budget night tomorrow to take any action that you might want to do about selling things. With the trust, it's a lot harder. You can't just go out and change your trust structure immediately. What's been proposed is perhaps a 30% minimum tax for trust structures, and for self-employed individuals out there and family group structures, they might be income splitting with other people in the family structure and taking advantage of the lower tax bands. What the ATO is potentially proposing is a 30% minimum tax, which would obviously be very different for those individuals. So right now, there's not much can be done before budget night tomorrow, but just kind of sit and wait and see what's going to be proposed. And then it's probably a chat with your tax advisor to understand if your structure still works.
I mean, that impacts a small few cohort of Australians, but, you know, people are exposed to shares in their superannuation. So that's where a lot of people think, oh, it doesn't really impact me. But inadvertently, the CGT changes, if they come into effect, will. If I can draw you now to some of the knowns that are coming out for individuals, some people might not be aware of some of these changes to work-related deductions. There's now a blanket $1,000 discount.
Yeah, I think this was out a few years ago, but kind of put to the side, and now it's back again. So the $1,000, you wouldn't need receipts for them, and you'd be able to just claim that automatically in your tax return. However, if you do have expenses beyond the $1,000, you would be able to do that. So I know it's all about thinking about how much is the deduction going to get me versus the effort to actually document and keep track of everything. So I think that'll be the new game we're all playing.
And what are some of the changes to salary sacrificing with respect to work items, say tech items like phones or laptops?
Yeah, because of this $1,000, there won't be a double dipping obviously allowed, so they wouldn't allow the salary sacrificing of those devices and those items anymore.
Okay, so no double dipping, as I presume you would always advocate for. With respect to superannuation, we know that there are some pretty big changes coming towards the time that your employer pays that. Can you take me through those changes and why it matters?
Yeah, no worries. So right now, most employers will have to the end of the quarter to make sure that your contributions for super are paid into the fund of your choice. What's going to change from 1 July is that they'll only have 7 days, which is a marked difference. Why it matters for you and I and all the other people working around is that we'll be able to see that our funds have been sent to the super fund by your employer. This whole regime was brought about to ensure that individuals were actually getting their money, and this reduction in time to actually send it over to the fund is aimed at making sure that the government can catch employers that are doing the wrong thing.
So Ursula, finally, in wrapping with this, only 24 hours or so until we find out, or a little bit longer, the details of the budget. If you were to leave my audience here today with, you know, one or two top take-home tips, what would it be to prepare themselves ahead of budget?
I think now is the time to look at your portfolio, your structures for your businesses, get that tax professional to see if they're really fit for purpose. It's time to look at your strategies and make sure that they're going to be aligned with how we're moving forward as a community.
Ursula Lepporoli, Victoria Tax Lead from KPMG, thank you very much for your time.
Thank you.